You see that clean head and shoulders pattern forming on your chart. Everything lines up perfectly, right? You enter the trade feeling confident, and then boom, your stop gets hit. A few minutes later, price takes off in the exact direction you predicted. You just sit there thinking, why does this always happen? Sounds familiar? Yeah, we've all been there. But here's the truth. It's not bad luck, and your strategy isn't the problem. What's really happening is something called invalidation liquidity. This is one of the sneakiest traps in the market. It looks like confirmation, it feels like confirmation, but in reality, it's where smart money comes to grab liquidity before the real move starts. In this video, we're going to break it down step by step. You'll learn what invalidation liquidity is, why it happens, and how you can finally avoid being the trader who gets taken out right before the market runs. So, grab your charts, stay tuned, and let's uncover what's really happening behind those perfect setups, right here on LutaMarkets. All right, so what exactly is invalidation liquidity? It's a very special type of inducement, and it forms when two key areas in the market line up almost perfectly. Let's call them point A and point B. Point A is what we call the invalidation point. This is usually a level where traders expect price not to come back to. It's often where they place their stop losses or where they think the market has already broken structure. Point B is the inducement liquidity. This level usually forms after the market has already made a big move, and traders start getting tempted to join in. It looks like a confirmation of the trend, and that's exactly what makes it dangerous. Now, here's the key part. When point A and point B line up at the same level, the market has just built invalidation liquidity, a powerful zone where both buyers and sellers have their liquidity stacked together. This is the area smart money targets. Let's talk about how traders fall into this trap, because this is something we've all done at some point. When price returns to that zone where A and B align, many traders start seeing patterns they recognize, things like a head and shoulders, a Quasimodo, or maybe even a break and retest setup. It feels like the perfect moment to enter. Everything looks aligned. You've got structure, confirmation, and even momentum, but that's exactly the trap. What's really happening is that price is revisiting a liquidity zone, an area filled with stop losses and pending orders, to collect liquidity before moving in the opposite direction. So traders enter confidently. The market dips just enough to take out their stops, and then it reverses hard, leaving them wondering what just happened. That's the power of invalidation liquidity. Let's break it down using the chart you see on the screen. We've got point A here, that's our invalidation point. Later on, the market forms point B, which becomes the inducement liquidity. Notice that both A and B are sitting at the same horizontal level. Now what happens next is classic. Price comes back, dips right below both A and B, grabs that liquidity, and then shoots up aggressively. That's not random movement, that's intentional liquidity collection. This move wipes out early sellers, triggers late buyers, and fills institutional orders. Once the liquidity is collected, the market continues in its true direction. This is how the market cleans the table before serving the real move. Now let's talk psychology for a moment. Why does this happen? Because the market runs on liquidity. Every big player, institutions, banks, smart money, needs counterparties to fill their large orders. So when the market sees a buildup of liquidity, meaning lots of stop losses or pending orders sitting at one level, it becomes a magnet. Invalidation liquidity forms because that's where the most emotional trading happens. Traders think they're right, they add confirmation, they scale in, but the market uses that emotion against them. It's not personal, it's just how liquidity works. The system needs liquidity to move, and retail traders unknowingly provide it. So what's the lesson here? When you see a setup where point A, the invalidation point, and point B, the inducement liquidity, form at the same level, slow down. Don't rush to enter. Recognize that this zone is not confirmation, it's a trap zone. Be patient and wait for the market to collect that liquidity first. When price sweeps below or above that area and then shows signs of rejection, that's your confirmation that liquidity has been taken and now the real move might be starting. That's how you position yourself with smart money, not against it. The truth is, most traders lose not because they don't understand patterns, but because they don't understand liquidity. They see a structure, they recognize a setup, but they don't realize they're entering right into a liquidity zone designed to take their position. Once you start seeing invalidation liquidity, your perspective on the market changes completely. You stop chasing every breakout, you stop getting trapped by fake confirmations, and you start waiting, patiently, for the liquidity grab before making your move. That's the mindset of a professional trader. If this video helped you understand something new, make sure you like this video, subscribe to LutaMarkets, and share it with your trading community, because knowledge only grows when it's shared. Stay patient, stay smart, and always remember, liquidity comes first.